is the stock market going through a major correction. If you look at the S&P 500 today, it does seem like the beginning of some sort of correction, because as we can see from July 16th to July 31st, it's down 2.62%. And in this video, we're going to explore what happened. CEO of the Goldman Sachs, David Solomon, believes that Federal Reserve will cut rate once or twice in 2024, different than the prediction he gave 2 months ago, where he predicted no rate cut in 2024. He believes that even though the economy is still relatively benign, but the prolonged inflation, even though it's improving, has softened consumer. And obviously, a softened consumer is one of the major concerns right now that's fueling this correction, because 2/3 of the US GDP comes from its consumers. This is the month-over-month percentage change of retail sales data, as we can see as we move further and further away from the pandemic. It does seem like the retail sales month-over-month change is slowly getting muted as people's pandemic saving gets depleted, and as the prolonged high inflation continue to go on, and prolonged high interest rate continue to go on, it does seem like there is a softening in the consumers. But the latest GDP shows us we are still very resilient. But this is what he talked about in terms of softer retail sales. And to improve everything, Federal Reserve is expected to announce September interest rate cut in the July FOMC meeting. So July, no change, but they're going to talk about changing it in September. So as the market reacts to that, we can see very clearly there is a sector rotation that's currently happening. Right now, the most mentioned rotation is the rotation into small caps from large caps. That's why we're seeing an outperformance of Russell 2000, even though S&P 500 is doing poorly in the past week. Right? And a outperformance in regional bank ETFs, right? They're the smaller regional banks. But there's also a sector level rotation that's happening. This chart shows you since the previous CPI report release date of July 11th, there's $6 billion flowing into non-tech ETF, and only $1.4 billion flew into the tech ETF, right? And the financial ETF has seen the greatest inflow with $2.8 billion. Even though I might have said it before, a Federal Reserve rate cut can hurt banks' net interest margin, right? Because they borrow from a low interest rate and lending it out at higher interest rate, right? It's going to hurt that margin when they cut rate. But the lower interest rate can actually lead to increased borrowing and lending activities, so they may end up lending more money out, right? So right now they are seeing this being a net beneficial thing for the bank sectors. And the market believes that the rate cut will also benefit other non-tech sectors more than the tech sectors, because usually large technology companies have ample cash reserve, meaning they have enough, right? And are less reliant on borrowing money to fund its capital expenditure or growth. And compared to the companies in traditional industries such as manufacturing, utilities, or even telecommunication, or like real estate. And based on the recent report from Bank of America, they believe that S&P 500 has no more room to grow for the rest of 2024, because their year-end target is 5,400, right? And that's pretty much where we are right now. We're actually a bit above 5,400 at the moment, so right. But they're saying that there are potential for strong returns among dividend stocks and old school capital expenditure beneficiaries like the infrastructure, the construction, the manufacturing stocks, and other themes that don't evolve around artificial intelligence. So pretty much she's saying all the traditional stocks, the value stocks are going to get benefited. So it's kind of reflecting what's currently happening in this sector level rotation we're observing at the moment. Essentially, Bank of America is saying there's no more room to grow for the overall market, and the traditional sectors or the value stocks will outperform, and the AI and technology sectors will underperform. And on artificial intelligence front, right, we recently saw the Microsoft releasing its quarterly report. Microsoft is one of the largest AI players, and we have Google reported a couple weeks ago, right? The report from Microsoft beats both the bottom line and the top line. But in after-hour tradings, the stock was down 5% at one point because of the disappointment in the AI business line and lower than expected outlook for the next earnings report, right? So the revenue from their Azure and other cloud services, right, they grew 29% during the quarter, but below the expected 31%, only a hair below the expectation. And the revenue outlook for the next earnings report is $64.3 billion, just below the $55.24 billion. So why is this a concern? Because people start to realize these AI companies, they spend a lot of capex, a lot of money investing in their AI technologies, doing their R&D. For example, on Google's earnings report, everything seems good, including the cloud business growth, but the stock price has been punished since they released the report. The market is worried about that. They spend so much money investing in AI, but they have trouble monetizing AI, right? That's the concern. So as a result of the concern, we're seeing a correction happening mostly in the large cap technology sector, bringing the entire stock market down. But it's also possible that we're just due for a correction because according to Bank of America, a decline of 5% or more in the S&P 500 occurs 3 times per year on average, and correction of 10% or more occurs once per year on average, based on the data going back to 1936. So far in 2024, we had only one pullback. That's just over 5%. So tell me, what do you think is going to happen? Do you think where we are right now, are we heading into a 5% correction or 10% correction, or are we heading into a 20% bear market? Please leave a comment in the comment section below. Thank you.